The world did not expect one policy to change global economics so suddenly. But that is exactly what happened when the United States introduced the trade measures widely known as the Trump trade shock. It began with a sweeping tariff plan that applied new taxes on most imported goods entering the United States. The idea behind the policy was simple on the surface, but extremely powerful in its impact. The United States wanted to protect its domestic industries, reduce dependency on foreign manufacturing, and reshape global trade relationships. However, the moment these tariffs were introduced, financial markets around the world reacted instantly. Stocks fell, currencies moved, and large multinational companies started recalculating their supply chain costs. The world was so interconnected that the policy did not stay inside America's borders. It launched a chain reaction that affected Asia, Europe, Africa, South America, and the Middle East, changing the way countries traded with each other and forcing them to rethink their economic strategies. The first major effect of the trade shock was immediate volatility in global markets. Investors who relied on predictable trade flows suddenly faced new uncertainty. Many companies that depended on imported materials saw their costs rise overnight. Industries like electronics, automobiles, machinery, and consumer goods were hit the hardest because their supply chains were deeply integrated across different countries. Components often came from multiple nations before becoming a final product. When tariffs increased, every step in this chain became more expensive. To adjust for these higher costs, many companies raised their prices, while others tried to find new suppliers, which required time, money, and negotiation. This sudden instability made global stock markets extremely sensitive, and many experienced noticeable drops as investors feared declining profits and slowing trade. One of the most visible results of the trade shock was rising prices for everyday goods. Tariffs operate like taxes on imports, and businesses often pass those taxes on to consumers. This meant that items such as clothing, electronics, household tools, and even food products began to cost more. Import-dependent industries had little choice because their profit margins were already thin. Experts pointed out that global inflation rose partly because of these trade barriers. When the cost of importing increases, it spreads through the entire supply chain. Transportation becomes costlier, retail prices climb, and operational expenses rise. Many central banks around the world had to adjust their interest rate policies to handle the inflation pressure created by the reduction in free-flowing trade. A global economic environment built on interconnected production suddenly had to face unfamiliar limits and restrictions. While many industries struggled, there were also winners in the short term. Countries not targeted by the tariffs saw new opportunities. For example, if the United States reduced imports from one nation, it often replaced those goods with imports from another. This process is called trade diversion. Some emerging economies took advantage of this moment by increasing production, attracting new buyers, and gaining market share that was previously held by other exporters. Certain agriculture exporters, raw material producers, and consumer goods manufacturers benefited from the sudden shift. However, the overall gain was uneven, and not all countries could adapt quickly. Many export-dependent nations that relied heavily on the U.S. market faced declines in sales, job losses, and economic slowdowns. Their factories reduced operations, and their governments had to manage the impact on workers and local businesses. Inside the United States, the expected manufacturing revival proved more complicated than originally promised. While some industries gained protection, others faced higher costs because they depended on imported parts. Manufacturing in the modern world is rarely isolated within one country. Building everything domestically requires investment, technology, specialized labor, and time. Many U.S. factories found that even though tariffs protected them from foreign competition, the cost of assembling products still increased due to the price of imported components. Reports showed fluctuations in manufacturing job growth, with some improvements in certain sectors, but losses in others. Many American manufacturers faced the challenge of balancing protection from imports with higher input costs from global supply chains. This mixed outcome created debate among economists and business owners about whether the policy strengthened or weakened long-term industrial growth. A major long-term risk created by the trade shock was uncertainty. Businesses everywhere make decisions based on predictability. They invest in factories, supply chains, shipping routes, and labor based on stable trade rules. When tariffs increase suddenly, or when trade policy becomes unpredictable, companies hesitate to invest. This hesitation slows economic growth across countries. Many global corporations delayed expansion plans because they feared future policy changes. Economists warned that prolonged uncertainty could discourage innovation, reduce productivity, and slow the speed at which economies grow. Trade wars in history have often shown that once trust in stable global trade is broken, it takes years to rebuild confidence and restore efficient supply networks. Another powerful consequence of the trade shock was the reorganization of global alliances. Countries that once depended heavily on U.S. trade began seeking partnerships with other nations. Regional trade agreements gained importance as countries looked for stable alternatives. Asian nations accelerated cooperation with each other. Some economies in Europe explored new trade opportunities in Africa and the Middle East. Even Latin American countries strengthened regional ties to reduce their vulnerability to global tensions. The world moved away from a model dominated by a few large powers and into a more fragmented system where multiple regional groups tried to secure their economic future. This shift increased competition for resources, markets, and political influence. Many analysts describe this as the beginning of a new era of economic geopolitics. On a strategic level, the policy highlighted a deeper challenge facing the global economy. Modern industries depend on global supply chains that stretch across continents. Raw materials may come from one region, components from another, assembly from a third, and final sale in a fourth. This creates efficiency, but also vulnerability. When one link in the chain breaks, the entire system suffers. The trade shock forced companies and governments to examine the risks within their supply chains. Many realized they lacked self-sufficiency in critical goods, such as semiconductors, pharmaceutical ingredients, rare earth minerals, and advanced machinery. Governments around the world began investing in domestic capabilities, encouraging local production, and supporting strategic industries. This transformation, however, is slow and expensive. It marks the beginning of a long-term trend toward reducing dependency on external suppliers. As the effects of the trade shock continued, the global economy entered a period of adjustment. Some countries moved quickly, adapting their industries, upgrading technology, and forming new alliances. Others struggled with declining exports and weakening currencies. Financial institutions monitored inflation, debt levels, and foreign investment flows closely. The global system became more complex and less predictable. Economists explained that this policy did not just change trade, it altered how countries think about national security, industrial planning, and economic independence. The belief that free trade automatically benefits everyone began to face new scrutiny. Nations no longer viewed trade purely as economic exchange, but as a tool of global strategy and political influence. In the end, the Trump trade shock became one of the most significant turning points in modern economic history. It reshaped global decision-making, redirected supply chains, and forced countries to reconsider their place in a changing world. The policy showed that a single nation's trade decision can transform global economics within months. Whether the long-term effects will strengthen domestic industries, create new global power centers, or lead to further economic fragmentation remains to be seen. But one truth is certain: the era of quiet, predictable global trade is over, replaced by a world where economic power is as important as military strength. For viewers watching today, understanding this change is essential. It affects the prices you pay, the jobs available in your country, and the economic direction of the world for decades to come. As we explore these shifts, HistoriNomica will continue to bring clarity to the financial forces shaping our future.